Trading is a mental game. You can have the best strategy, the most accurate indicators, and a clear plan in mind, but without the right mindset, all of that will be for nothing. Emotions are the unseen forces that affect every decision you make as a trader. They sneak in during the highs and the lows, pushing you to act impulsively, doubt yourself, and sometimes even abandon your strategy. So how do you separate your emotions from your trading? Let's start with a simple reality. Your emotions are not your enemy, but allowing them to drive your trading decisions can be. Emotions like fear, greed, excitement, and frustration are natural, and you will always feel them in trading. The real problem is when they influence your decisions, and that's when you lose control. If you've been trading for any amount of time, you know exactly what I'm talking about. You enter a trade, and everything seems to be going perfectly. But then, the price moves against you just a little, and suddenly, you start to panic. The fear sets in. You start thinking about the money you're about to lose. Maybe I should close this trade early, you think. I'll cut my losses before they get worse. You hit that close button, and the market turns around, heading in the direction you expected all along. The regret hits you like a truck. On the flip side, after a few wins, you start to feel like you're on top of the world. The excitement takes over. You see the next trade, and without a second thought, you dive in. But this time, the market goes against you. You start chasing the trade, doubling down, hoping to get back to where you were. You're trading based on excitement and greed, not logic. And guess what happens? Another loss. This cycle of emotional highs and lows is normal for many traders. It's easy to get wrapped up in the emotions that come with every win and every loss. But here's the thing. Emotions are not your trading plan. The more you let emotions drive your trades, the more likely you are to lose control of your trading. So how do you break free from this emotional roller coaster? How do you stop letting fear and greed control your decisions? The answer is simpler than you might think. Separation. You need to learn how to separate your emotions from your trades. It's about creating a mental barrier between how you feel and what you do in the market. It's not easy, but it's essential for long-term success. And here's why. Trading is about consistency. Successful traders know that it's not about making one or two big wins. It's about making good trades consistently over time. And consistency doesn't happen when you're chasing wins or running from losses. It happens when you follow your plan, stick to your rules, and take the next trade only when the setup fits your strategy, no matter what the market is doing. But here's the kicker. Emotions are unavoidable. You will feel fear when you're in a losing streak. You will feel excitement after a few wins. And that's okay. What matters is how you manage those emotions. You need to acknowledge them, but not let them dictate your actions. In this video, I'm going to show you how you can separate your emotions from your trading and make better, more rational decisions in the market. This is a key skill that all successful traders have mastered. The market doesn't care about your feelings, and neither should you. When you separate your emotions from your trades, you can execute your strategy with confidence, stay disciplined, and make fewer impulsive decisions that harm your account. But first, let me ask you a question. How many times have you traded based on how you felt instead of following your plan? How many times has fear caused you to close a trade too early? Or how many times has greed pushed you to enter a trade that didn't fit your strategy? Take a moment to reflect on that, and if you've experienced this, leave a comment below saying, "I've been there," to let me know that you're still with me and absorbing the information. It's important to recognize these patterns so that you can break them. By the end of this video, you'll have a clearer understanding of how emotions influence your trading, and more importantly, how to build habits that help you stay emotionally detached, rational, and consistent. It's time to stop letting your feelings rule your trades and start making decisions based on logic, strategy, and discipline. Now that we've introduced the idea of separating emotions from trading, let's take a closer look at the specific emotions that can influence your decisions. Fear, greed, and excitement are the big ones, but there are many other emotional triggers that can impact your trading. To become a successful trader, it's essential to understand what these emotions are, why they occur, and how you can manage them effectively. Let's start with fear. Fear is one of the most powerful emotions in trading. It's the feeling that creeps up when you see a loss mounting or when the market seems to be moving against you. It's natural to fear losing money, but when that fear takes over, it clouds your judgment. You might start second-guessing your strategy, doubting your decision to enter a trade, or worst of all, you may close a trade early, just to avoid the pain of seeing a loss grow. Fear leads to impulsivity. When you act out of fear, you make decisions that aren't based on your plan or strategy. You might move your stop loss because you're afraid of taking a loss, or you might bail out of a trade before it reaches its target. Fear can make you close a trade too soon or hesitate to enter a trade when you should. In either case, it's damaging to your trading performance because you're no longer making decisions based on logic or strategy. You're making them based on emotion. The key to managing fear is acknowledging it and accepting it. Fear is normal. Every trader experiences it, but the difference between successful traders and those who fail is how they respond to it. Instead of letting fear dictate your actions, you need to learn to pause. When you feel fear creeping in, step back for a moment, take a deep breath. Remind yourself that fear is a natural part of trading, but it's not a reason to abandon your plan. Trust in your strategy and don't let fear make decisions for you. Next, let's talk about greed. Greed often comes into play after a series of wins. You're feeling good about your trades, your confidence is high, and suddenly you start thinking, why stop here? I can make more. I deserve more. That's when greed takes over. You start chasing after bigger profits, taking larger risks, and opening trades that don't fit your plan. Maybe you increase your position size, or you start ignoring your stop loss because you think the market is going to keep moving in your favor. But here's the problem. Greed leads to reckless decisions. When you let greed control your trading, you stop following your plan. You start thinking that the market owes you something, and you try to force a trade that doesn't exist. You may end up losing all the profits you've made, and even worse, you might lose more than you can afford. Greed makes you overestimate your abilities and underestimate the risks, leading to impulsive decisions that are based on emotion, not logic. The solution to greed is discipline. Discipline is what keeps you grounded and reminds you that trading isn't about instant gratification. It's about sticking to your plan and executing it consistently. After a win, it's natural to feel good, but remember that the market doesn't owe you anything. If you start feeling the temptation to trade just to make more money, take a step back. Focus on the process instead of the outcome, and don't let greed push you off course. Now, let's talk about excitement. Excitement is a tricky emotion in trading. It's the feeling you get when everything is going right. You've made a profitable trade, and suddenly you feel invincible. The market seems to be on your side, and you're eager to keep going. But here's the danger. Excitement can cloud your judgment just as much as fear and greed can. When you're excited, it's easy to get carried away. You start taking more trades than you should. You start pushing the limits of your risk tolerance because you believe the good times will keep rolling. But excitement often blinds you to the risks. You might start making decisions based on a rush of positive emotions rather than following your trading plan. Excitement can make you forget the very reason you entered the market in the first place, to trade strategically and consistently. The antidote to excitement is calmness. You need to learn how to temper your enthusiasm and stay focused. After a win, celebrate briefly, but then get back to your plan. Treat every trade with the same level of care and attention, no matter how good you feel about the last one. A professional trader treats every trade with respect, whether they're winning or losing. They don't let excitement push them to make rash decisions. Instead, they take a deep breath, stay calm, and execute the plan as they would if the market was indifferent to them. There's also regret, which can be equally damaging. You know the feeling, you're in a trade and you close it early, only to watch the market turn in your favor right after. You kick yourself and think, I should have stuck with it. Why did I close early? Regret leads to revenge trading, where you jump into a trade with the goal of making it back. Revenge trading is a dangerous cycle because it's based on the desire to recover from a perceived mistake, and it often leads to even more mistakes. The way to break the cycle of regret is acceptance. Understand that not every trade will be a winner. Losses are part of trading. Instead of focusing on what you could have done, focus on what you will do next. Accept that each trade is an individual outcome, and the goal is to execute your plan consistently over time. If you made a mistake, learn from it, but don't let regret dictate your next move. Finally, there's hope, and while hope can seem like a positive emotion, it can also get you into trouble. Hope arises when you're in a losing position, hoping that the market will turn around. But hope is not a strategy. When you're hoping the market will move in your favor, you stop thinking clearly. You start ignoring your plan, your stop loss, and your risk management rules. Hope makes you emotionally attached to a trade, and attachment leads to poor decision-making. Instead of hoping, trust your strategy. A well-tested strategy will perform over time, but you have to stick to it even when things are going against you. Hope can lead to desperation, and desperation leads to overtrading, which we've already seen is the path to destruction. The bottom line is this: emotions will always be a part of trading, but they don't have to control your decisions. Fear, greed, excitement, regret, and hope are all natural emotions, but they only hurt you when you let them drive your actions. By recognizing these emotions for what they are and learning how to manage them, you'll be able to separate them from your trading and make more rational, effective decisions. So, I want to check in with you again. How many of these emotions have you experienced in your own trading? Is fear, greed, or excitement affecting your decisions? Drop a quick comment below saying, "I'm aware of my emotions," just to let me know that you're paying attention. It helps me know you're following along, and I love hearing about your own experiences. Now that we've identified the emotions that affect your trading, let's talk about how to manage them. Knowing that emotions are a natural part of trading is one thing, but being able to control them and make better decisions when they arise is another challenge entirely. In this section, we're going to go through some practical techniques that will help you separate your emotions from your trading. The first technique is one that may sound simple, but it's incredibly powerful. Create a trading plan and stick to it. This may seem obvious, but the reality is that most traders don't follow through with this. They have a plan, but they don't stick to it when things get tough. When emotions like fear, greed, or excitement kick in, it's easy to forget about the plan and make decisions based on how you feel in the moment. A trading plan is your blueprint. It outlines your strategy, your risk management rules, and your goals. The more detailed and structured your plan is, the less room there is for emotional decisions. Your plan should tell you exactly when to enter a trade, when to exit, and how much risk you're willing to take. If you follow the plan, you're less likely to be influenced by emotional impulses. One of the most important aspects of a trading plan is risk management. This is the part of your plan that tells you how much you're willing to risk on each trade. Without proper risk management, emotions take over. You might start taking larger positions after a loss, hoping to make it back, or you might risk too much because you're chasing the high of a big win. But controlled risk keeps you grounded. It allows you to take the next trade without worrying about blowing up your account. The next technique is to remove yourself from the screen when emotions are running high. This may sound simple, but it's one of the most effective ways to separate emotions from your trading. Let's say you're in a trade, and the price starts to move against you. Your heart races, and you start feeling the urge to exit the position early. Instead of acting on that fear, step away from your computer or phone. Take a walk, grab a cup of coffee, or do something else for a few minutes. Give yourself space to calm down and let the emotional rush settle. It's easy to act impulsively when you're in front of the screen, but when you step away, you give your brain a chance to reset. You remind yourself that it's just a trade and that you don't need to act on impulse. This break gives you time to think logically and come back to your trading plan with a clearer mind. If you feel your emotions getting the better of you, don't be afraid to walk away for a moment. It can be the difference between a rational decision and a hasty, emotional one. Another technique that helps you separate emotions from trading is journaling. Keeping a trading journal is one of the most valuable tools you can use to improve your mindset and emotional control. After each trade, write down how you felt during the trade, what you were thinking, and why you made the decisions you made. Did you feel anxious, excited, overconfident? These reflections help you see patterns in your emotional responses and can help you identify areas where your emotions are influencing your decisions. A journal also helps you to track your trading performance over time, which is key to improving. You'll be able to see which strategies worked, which ones didn't, and whether your emotions were affecting your performance. By analyzing your journal, you'll become more aware of how you feel during different market conditions, and you can start to make changes to your approach. Journaling helps you build a mental audit trail, and as you get more consistent, you'll learn to recognize emotional triggers before they become a problem. Here's another powerful technique. Predefine your entry and exit points. When you plan your trades in advance, you take the guesswork and the emotions out of the equation. Knowing exactly where you'll enter and exit helps you stay disciplined, even when the market starts to move against you. When you don't have predefined levels, it's easy to get caught up in the moment and react emotionally to market moves. But by setting your entries and exits in advance, you make it easier to follow your plan and reduce the risk of emotional decisions. For example, if you know that you'll enter the market only when a certain price level is reached, or when a specific indicator signals a trade, you can avoid chasing the market. You can also set stop losses and take profit levels in advance, so you don't have to constantly monitor the trade and feel the emotional pull to adjust your position. Predefining these levels takes the stress out of the equation and helps you stick to your strategy. Another technique that's incredibly helpful is setting time limits for your trades. Sometimes traders feel compelled to stay in a trade for longer than they should, hoping for a reversal or a better outcome. But the reality is that some trades just don't work out. It's okay to cut your losses and move on to the next opportunity. By setting time limits on your trades, you're giving yourself permission to exit the trade without looking back. This helps to prevent the emotional attachment that often leads to holding on to losing trades for too long. For example, you could decide that if a trade doesn't reach a certain price target within 30 minutes or an hour, you'll exit the trade and move on. This forces you to make rational decisions based on your plan, rather than emotional impulses. It also prevents you from trying to force a trade to work when the market isn't cooperating. One last technique I want to share is mindfulness. Mindfulness is a practice that helps you stay present in the moment without getting swept away by your emotions. It's about observing your thoughts and feelings without judgment. When you're trading, practicing mindfulness helps you stay grounded and aware of your emotional state. Instead of letting fear, greed, or frustration control your actions, you can observe those feelings and acknowledge them without acting on them. Mindfulness can be as simple as taking a few deep breaths before you place a trade. It's about pausing, recognizing how you feel, and making a conscious choice to trade based on your plan, not your emotions. Over time, mindfulness helps you build mental resilience, making it easier to stay focused, calm, and disciplined during both wins and losses. Now that we've covered several key techniques to separate emotions from your trading, let me ask you, have you tried any of these strategies in your own trading? If so, leave a comment below saying, "I've started implementing these techniques," to let me know you're taking action. By now, you've learned that emotions play a massive role in how you trade. But emotions aren't the only thing that can affect your trading. One of the most important factors in becoming a successful trader is mindset. Your mindset is what keeps you grounded when things are going wrong, and it's what propels you forward when things are going well. It's what helps you stay disciplined and focused, no matter how many trades you've won or lost. Most traders, especially beginners, tend to think that trading is all about the next trade, the next win, the next big move, the next opportunity. And while those moments might feel exciting, they're actually short-term thinking. Trading isn't about hitting a home run on every trade, it's about long-term consistency. And to achieve that, you need the right mindset. The first step in building a successful trader's mindset is accepting that losses are part of the game. When you start trading, you might be afraid of losing. After all, no one wants to lose money. But the reality is that losses are inevitable. In fact, they're built into the process. If you're not experiencing losses, you're either lucky or you're not trading enough. Every single successful trader has faced losses, and it's how they handle those losses that sets them apart. A big mistake many traders make is seeing a loss as personal failure. They feel like they've done something wrong, and that sense of failure leads to emotional decision-making. They might make impulsive trades or risk more money trying to recover the loss, which only leads to more mistakes. The truth is, losses are just part of the process. They're not a reflection of your ability as a trader. They're simply part of the odds and probabilities. The right mindset means accepting losses without letting them define you. Instead of focusing on the loss itself, focus on the process, on how well you followed your plan, on whether you stuck to your rules, and on whether you made a rational decision. When you make the right decision and lose, it's not your fault. It's just part of the journey. But when you make an impulsive decision and lose, then you need to learn from that mistake and adjust. Building the right mindset also means embracing patience. Trading is a marathon, not a sprint. It's easy to get caught up in the excitement of big wins, but those moments are often rare, and they can create unrealistic expectations. A lot of traders fall into the trap of chasing after quick profits. They want to get rich fast. But that kind of thinking is dangerous because it leads to emotional decision-making, overtrading, and poor risk management. The successful trader's mindset is focused on slow, steady growth. It's about accepting that progress is gradual. It's about building a foundation of consistent, reliable trades over time, not looking for that one trade that will change your life. You need to remember that compound growth is your friend. If you can make small, consistent profits, they'll add up over time. It might not feel like much in the beginning, but over the long haul, you'll see the power of slow, steady growth. Long-term thinking also means trusting your strategy. Your strategy is your roadmap, and it's the key to your success. But if you don't trust your strategy, you'll constantly second-guess yourself and make decisions based on emotion, not logic. Trusting your strategy means believing in your plan, even when the market goes against you. It means staying disciplined and not abandoning your strategy just because you're on a losing streak. When you trust your strategy, you stop focusing on the outcome of individual trades. You stop thinking, if I win this trade, I'll be rich. Instead, you think, this trade is just one step in the process. I'll win some, I'll lose some, but if I follow my plan, I'll be profitable over time. This mindset shift is what separates successful traders from those who fail. The key is to stay focused on the process, not the outcome. And to keep your mindset strong, you need to reflect regularly on your performance. This is where journaling comes in again. By writing down your thoughts and feelings after each trade, you can reflect on how your emotions influenced your decisions. Did you make a rash decision out of fear or greed? Did you stick to your plan, or did you abandon it halfway through? Reflection helps you grow and learn from your mistakes. It helps you refine your strategy and improve your emotional control over time. Another important aspect of building a long-term mindset is to manage your expectations. Many traders get into the market expecting to make quick profits. When they don't, they get frustrated and lose faith in their strategy. But successful traders understand that it's not about quick wins. It's about small, consistent victories over time. The best traders set realistic expectations for themselves. They don't expect to double their account in a month. They understand that profits will come, but they'll come slowly. And that's okay, because slow growth is sustainable growth. Lastly, resilience is a critical part of the mindset for long-term success. The market will test you. You'll experience losses. You'll feel frustrated. But what separates the successful traders from the unsuccessful ones is their ability to bounce back. Resilience is about maintaining your discipline, staying patient, and trusting your strategy, even when things don't go your way. Every loss is an opportunity to learn, to grow stronger, and to become a better trader. Now, I want to check in with you. Do you feel like you're embracing a long-term mindset in your trading? Have you experienced any of the emotions we talked about, and how did you handle them? Leave a comment below saying, I'm building my long-term mindset, so I know you're following along and ready to embrace a disciplined approach to trading. Now that we've covered the emotions that can interfere with your trading, the mindset you need for long-term success, and how to manage your emotions, let's wrap things up by focusing on one of the most important aspects of successful trading: consistency. If you want to be successful in trading, consistency is the key. It doesn't matter how great your strategy is if you don't stick with it day in and day out. Consistency is what separates successful traders from the ones who keep losing their capital. The reality of trading is that there are no shortcuts, no magic formulas, no easy wins. It's about taking one trade after another, following your plan, and sticking to your rules, no matter how you feel or what the market is doing. But consistency isn't just about trading the same way every day, it's about following a well-structured trading plan. A solid trading plan is the foundation of everything you do as a trader. Without one, you're essentially flying blind. So how do you build a trading plan that can help you achieve consistent results? A good trading plan starts with defining your goals. Before you even think about placing a trade, ask yourself, what am I trying to achieve with this trade? Are you looking to grow your account over time? Are you trying to make a quick profit? Are you in it for the long haul? Knowing what you want to accomplish helps you focus your decisions and avoid impulsive actions based on short-term emotions. Next, a good trading plan should include your risk management strategy. This is crucial because it helps protect your account and keeps you from risking too much on any single trade. The first rule of trading is to never risk more than you can afford to lose. This means setting stop losses, defining your position size, and knowing how much of your account you're willing to risk on each trade. When you follow a solid risk management strategy, you're giving yourself a safety net, so even if you lose a trade, you're not putting your entire account at risk. Risk-reward ratio is another key component of your trading plan. This is how you balance potential profit with potential risk. Let's say you're risking $100 on a trade. A good rule of thumb is to aim for a reward of at least $200 for that trade. That gives you a 2.1 risk-reward ratio. The reason this is so important is that it helps ensure that even if you have more losing trades than winning ones, the winners will be bigger than the losses, keeping you in the game. But remember, it's not just about numbers. Your plan should also outline when to enter and exit trades. You need a clear, defined set of criteria that tells you when a trade is a good opportunity. This could be based on technical indicators, support and resistance levels, or specific price patterns. The idea is that when these conditions are met, you know it's time to enter the trade, and you can confidently make that decision without being swayed by emotions. Your exit strategy is equally important. Knowing when to get out of a trade, whether you're taking profits or cutting losses, can make all the difference. A solid exit strategy is about sticking to your plan and not letting emotions drive you to close a trade too soon or hold on to a losing position for too long. By setting take-profit levels and stop losses in advance, you remove the emotion from the decision-making process. But here's the thing. Building a trading plan and sticking to it isn't enough if you don't follow through. This is where consistency comes in. The key to consistent success in trading is sticking to your plan day after day, week after week, no matter what happens. There will be ups and downs, good days and bad days. You might go through losing streaks or see a trade go against you. But the best traders are the ones who keep going, who keep executing their plan consistently, even when things aren't going well. It's easy to get caught up in the excitement of a winning streak, but staying consistent through the losses is what truly separates the professionals from the amateurs. It's about doing the same thing over and over again, even when the results aren't instant. The market doesn't reward those who try to time every perfect entry. It rewards those who have a system, stick to it, and trust the process. Here's where the power of small, steady progress comes in. In trading, you don't need to hit a home run every time. In fact, hitting consistent smaller wins is often much better than trying to catch huge profits on every trade. Think about it this way. If you're consistently making small profits over time, those profits start to add up. They compound. The more you stay consistent and follow your plan, the more your account grows steadily. But how do you stay consistent when the market throws a curveball? Accountability is a huge part of the answer. One way to hold yourself accountable is by reviewing your trades regularly. This doesn't just mean looking at your wins and losses, it's about examining your decision-making process. Did you follow your plan? Did you stick to your risk management? Did you make any emotional decisions? This kind of review process helps you stay honest with yourself and ensures you're learning from each trade. Another way to improve consistency is by creating trading habits that work for you. Just like any other skill, trading requires practice. The more you make trading a habit, the easier it becomes to stay disciplined. This means setting aside specific times to trade, creating a routine for preparing your trades, and having a system in place to track your performance. The more structured your approach, the easier it is to stay consistent. The final element of consistency is mental resilience. Trading is hard, and it's not always easy to stay calm and focused, but it's your ability to bounce back after a loss and stay committed to your plan that defines your success. Resilience is about staying grounded, not letting fear or excitement dictate your actions, and trusting that your system will pay off over time. Now that you have a solid understanding of why consistency is the foundation of successful trading, I want to ask, are you committed to following your trading plan consistently, no matter the market conditions? If you are, leave a comment below saying, "I'm committed to consistency," so I know you're ready to take action. And remember to like and subscribe.